Last week, while everyone was arguing about whether AI was going to steal our jobs, a much quieter financial revolution was happening right under our noses. The earned wage access industry, those apps that let you get paid before payday, just hit some pretty wild numbers that should make everyone sit up and pay attention. This simultaneously shocked absolutely everyone and absolutely nobody at the same time. The market went from $2.8 billion in 2023 to a projected $21.5 billion by 2032. That's a 25.3% compound annual growth rate, which in normal human terms means this thing is growing faster than your credit card debt after a Vegas weekend. Most people understand that when something grows this fast, there's usually a catch. But they also understand that sometimes these financial innovations actually help people. For every argument that these apps are predatory, there's a counter argument that they're saving people from payday loans. You don't need to watch another video speculating about the future of fintech because the truth is nobody has a damn clue whether this is going to end well. But what we can do is look at the actual numbers behind this $21.5 billion promise and figure out if this is actually making people's lives better or just creating a fancier way to stay broke. So everybody's been paying attention to the feel-good marketing campaigns. You've probably seen the ads, hardworking Americans getting instant access to their earned wages, avoiding overdraft fees, building financial freedom one early paycheck at a time. The companies pushing this stuff, DailyPay, Payactiv, Wagestream, they've got some pretty compelling statistics to throw around. 67% of users report a positive impact on their financial situation. Employers see up to 50% reduction in staff turnover. Workers avoid borrowing from friends and family 31% of the time. When you put it like that, it sounds like everybody wins. Now, to be fair, we kind of have to acknowledge that for a lot of people, this stuff is genuinely useful. People aren't using these apps to buy PlayStation games. They're using them for food, rent, transportation, and utility bills. That's not frivolous spending, that's survival spending. When you're comparing a $1.75 transaction fee to a $26.51 overdraft fee or a 400% APR payday loan, the math seems pretty obvious. But all of this warm and fuzzy stuff probably means a lot less than you think. User satisfaction surveys are a bit like asking people if they enjoyed their payday loan while they're still spending the money. The real question isn't whether people feel good about using these services, it's whether these services are actually making people financially better off in the long run. The actual numbers we should be paying attention to are not the feel-good survey results, but the actual resources that people are putting into this system versus what they're getting back out. And by resources, you can't just think about the transaction fees. Those fees are really just the receipt for a much bigger cost. Let's do some Age of Empires style resource accounting here. FlexEarn charges £1.75 per transaction, which sounds like pocket change, until you realize that if you're a worker earning £400 per week and you access your wages twice per pay period, you're looking at £182 per year. That's 1.2% of your gross income, which means you're essentially paying a tax on being poor. But wait! It gets worse. A Connecticut EWA user study found that most users access wages once or several times per pay period. For someone getting paid bi-weekly, that could mean 26 to 52 transactions per year. Even at modest fees, that's starting to add up to real money that could have gone toward actually building an emergency fund instead of funding the emergency itself. And here's where it gets really fun. 27% of users believe they should use these services less frequently. That's more than 1 in 4 people who recognize they might be developing a dependency on accessing their future earnings. It's almost like the industry designed a product that's really good at creating repeat customers. Now, if the fee structure sounds just a little bit concerning to you, don't worry. It's actually worse than you think, because these companies have the same problem that every other tech company has. Their product only works when it actually works. Rain users on Trustpilot are constantly complaining about balance updating problems. DailyPay users report delays in transfers and discrepancies in available balance calculations. When you're living paycheck to paycheck and you need emergency access to your earned wages, app malfunctions don't just create inconvenience, they create the exact financial crisis these services claim to prevent. This technological treadmill has created something pretty unique in the financial services world. A product that promises to solve financial emergencies but can actually cause them if the servers go down at the wrong time. But that's just the first item on the cost sheet. The real expense here isn't the transaction fees or even the technical problem. It's something economists call opportunity cost, and it's about to get expensive. When you make earned wages instantly accessible, you fundamentally change how people think about money and time. Instead of budgeting across a 2-week pay period, workers are managing finances on a daily or weekly basis. That might sound more flexible, but it's actually removing one of the most important skills for long-term financial health: learning to live within a regular budget cycle. 60% of DailyPay users who receive bi-weekly paychecks but access wages multiple times per period aren't just changing when they get paid, they're changing how they think about money entirely. And once you've trained your brain to expect instant access to future earnings, going back to traditional budgeting becomes almost impossible. This is creating what we might call the paycheck to paycheck paradox. Services designed to help people escape living paycheck to paycheck may actually be making it harder to develop the financial habits that would break that cycle permanently. Earlier this month, a group of researchers started making headlines after they published some pretty damning data about where all this growth is actually happening. Turns out that while the EWA industry is booming globally, 42.4% of the market is concentrated in North America. It's great if you live in Connecticut, but not so helpful if you're a gig worker in Bangladesh who actually needs these services. The geographic concentration of these services raises some uncomfortable questions. If EWA is such a revolutionary solution to financial inequality, why is it primarily available to workers in the world's wealthiest countries? It's almost like this industry is less interested in solving global poverty and more interested in extracting fees from people who already have access to traditional banking. Within the markets they do serve, the adoption patterns tell an even more interesting story. Hourly workers in retail, hospitality, and healthcare show the highest usage rates, while salaried employees in professional services barely use these products at all. This suggests that EWA isn't providing universal financial solutions, it's providing expensive solutions to people who can't afford expensive solutions. Now, some of the largest EWA players have responded to growing criticism by doing what every financial services company does when they start getting attention from regulators. They hire lobbyists and start talking about innovation and financial inclusion. But the regulatory environment is already changing. Connecticut implemented new EWA regulations effective January 1st, 2024, and remarkably, 91% of users were aware of these changes. That suggests that when governments start paying attention to this industry, it significantly impacts how these services work and who can afford to use them. The industry's ability to maintain its 25.3% annual growth rate while adapting to increasing regulatory oversight will be the real test. History suggests that when financial services grow this fast, regulators eventually show up to ask some uncomfortable questions about who's really benefiting and who's paying the bill. The costs of getting EWA to where it is now have been substantial, but when you do a cost-benefit analysis, you also have to look at the benefits. Only problem is those benefits have been surprisingly hard to measure in any meaningful way. North America holds $2.62 million in current revenue, with projections suggesting the global market could reach $242.46 billion by 2034. That's a lot of transaction fees being collected from people who, by definition, don't have enough money to wait until payday. But maybe we're missing something here. Companies like Relevate have dispersed over $1 billion across 3 million accounts, which sounds impressive until you realize that's an average of about $333 per account. For context, that's less than most people spend on their phone bill in a year. When you add up all the costs, transaction fees, behavioral changes, technological dependency, and opportunity costs, you start to get a clearer picture of what this industry is actually selling. It's not financial freedom. It's not even financial stability. It's instant gratification disguised as financial innovation, marketed to people who can't afford to wait 2 weeks for money they've already earned. 67% of users who report positive impacts aren't wrong. Accessing your paycheck early probably does feel better than overdrafting your account, but feeling better and being better off are two different things. And when an industry grows from $2.8 billion to $21.5 billion by charging fees to people who are already financially stressed, we might want to ask some harder questions about who's actually winning this game. The ultimate test isn't going to be the growth rates or user satisfaction survey. It's going to be whether people who use these services for a few years end up more financially stable or just more comfortable with living paycheck to paycheck.